Most people think banks decide fixed mortgage rates. They don't. The bond market does. And if you understand that, then you understand why fixed rates can move even when the Bank of Canada hasn't changed anything. Earlier this week, the Government of Canada 5-year bond yield was sitting in the lower 2.7% range. A couple of days later, it moved closer to 3%. Now that might not sound like much, but in bond market terms, that's a meaningful shift in a short period of time. So what does that actually mean for your mortgage? Especially if you're someone who's going to renew their mortgage, or if you want to refinance, or if you want to purchase a property. Let me simplify it for you. The 5-year Government of Canada bond acts as a baseline cost for money. When investors buy those bonds, they demand a return, and that return is the bond yield. If investors begin demanding a higher return because of inflation expectations, economic data, government borrowing, or global uncertainty, bond yields rise. And when bond yields rise, money becomes more expensive in the broader financial system. And lenders, they fund fixed rate mortgages using money priced relative to those bond yields. So when the 5-year yield moves from 2.7% towards 3%, lenders' costs start to increase. And when funding costs increase, that creates an upward pressure on fixed mortgage rates. It doesn't always mean an immediate retail change, so you're not going to see rates going up and down very quickly, but the pressure starts to build. And then the opposite is also true. If bond yields fall, then funding costs ease, and that creates a downward pressure on fixed mortgage rates. This is why watching the Bank of Canada alone is not enough. The bank controls the overnight rate, which impacts variable mortgages. But fixed rates are primarily driven by bond yields, and bond markets, they move in real time. Now, most homeowners aren't watching bond yields, and realistically, you shouldn't have to. That's the difference between simply quoting a rate and understanding what's driving that rate. My name is Michelle Brienza. I've been in this industry for almost 3 decades now. I can't believe it. I work entirely by referral, which means I don't build my business on hype. I build it on trust. My role isn't to predict markets perfectly. It's to understand them, to watch them, and to guide you through them calmly and strategically. In a market like this, noise is everywhere, but clarity actually matters. So if you're trying to understand where fixed rates are going to go, yes, watch the bond market, but more importantly, work with someone who's already been watching it for quite some time. Because this isn't about chasing headlines, it's about making confident, informed decisions that support your life, not just your rate. Until next week, be well.